10 tips for deducting losses from a disaster. National hurricane season is officially in progress. We have started. If you suffered damage to your home or personal property from a storm, you may be able to deduct the losses you incur on your federal income tax return. And we're going to give you 10 tips that you should know about deducting what's called casualty losses. Casualty loss is based on the damage done to your property during a disaster. Now, a casualty is a sudden, unexpected, or unusual event. This may include natural disasters like hurricanes, tornadoes, floods, and earthquakes. But it will also include losses from fires, accidents, thefts, or vandalism. In other words, something that happens unexpectedly and quickly. Normal wear and tear is not deductible. Kind of termite damage would be an example. Whereas things get old and decay. That's not a casualty loss. Now, if you're covered by insurance, you've got to file a timely claim for reimbursement of your loss. Otherwise, you cannot deduct the loss as a casualty or theft. You must reduce your loss by the amount of reimbursement you received or expect to receive from your insurance company. You can take the deduction as a general rule in the year it occurred. However, if you have a loss from a federally declared disaster area, you may have a choice of when you can deduct that loss. You can choose to deduct it on a prior year's return. You may have to file an amended return for the immediate preceding tax year. That way you could get a refund a lot quicker. Claiming a disaster loss on the prior return would result in a lower tax for that year in some cases, which would produce the refund, which you may get more quickly than waiting for the current year to come to an end to be able to take that deduction. The amount of the loss, this can get a little tricky, but you need to follow these steps. First, you determine your adjusted basis in the property before the casualty. For property that you buy, your basis is usually its cost to you. For property you acquire in some other way, such as inheriting it or getting it as a gift, you must figure your basis in a different way. And how to figure that, you determine the decrease in the fair market value, also call it FMV, of the property as a result of the casualty. In other words, whatever the decrease in the value from before the storm to after the storm would be your casualty. And once you get what that difference is, or what that casualty loss is, then you subtract any insurance or other reimbursement you received or expect to receive from the smaller of those amounts. There's a $100 rule. After you have figured your casualty loss on a personal use property, you must reduce that loss by $100. This reduction applies to each casualty loss event during the year. It does not matter how many pieces of property are involved in an event. What that means is that when you have the casualty, you can kind of include everything together in it. It's not $100 for each piece. The 10% rule comes into effect after you get that figure. You must reduce the total of all your casualty or theft losses on your personal use property for the year by 10% of your adjusted gross income. Adjusted gross income is the total income at the bottom of page 1 of your 1040, the top of page 2. So if you have a $40,000 adjusted gross income on your 1040, your personal tax return, that means that $4,000 gets subtracted from your casualty loss. So if you have, all of a sudden you're walking down the street and somebody decides to hold you up and they take your Rolex, which was $4,000, you would first, because that is an unexpected and immediate loss, You report the claim to the police, get a loss notice with them, report it to your insurance company. If you get a reimbursement of any amount, that reduces the amount of your loss from $4,000 down to a lower number. And if you're in the $40,000 tax bracket, 10% of that is $4,000, therefore you write nothing off. Future income does not count as a casualty. So if you lost the ability to earn income, there is no loss for that. And I guess the reason they have for that is that income's not being counted as income, therefore on any return, so therefore you can't take a loss for income that wasn't reported. What form do you use? Form 4684. Just attach it to your 1040. Just follow through the schedule. Business or income property. It is different for businesses. Some of the casualty loss rules for business or income property are different than the rules for property held for personal use. If you have any questions or need assistance, don't hesitate to call us at 561-744-9547.